Hi everyone, this is Prachi. Good day to you all. Welcome to Quarter 1 FY26 episode of Commodities and Currencies Monitor. We have with us our currency and commodities expert, our analyst, Ms. Riya Singh. Hi Riya.
Hi,
How are you?
I'm good.
So, after a lot of trauma and drama in the US dollar, dust has finally settled. Of course, there are a lot of happenings which are still going on. So, how do you see the trend for US dollar now?
Well, like you said, there is a softening that is happening with the US dollar. So it has come on the back of de-escalation between US and China trade tensions, and also the recent economic numbers that have come forth for the US. So on that part, if you look, the PMI numbers are down. We are seeing flattening of US retail sales, and even the inflation numbers have come down. It has come below the consensus. If you look at the month-on-month growth, it is at 0.2%. So this has been one of the driving factor which has led the slide into the dollar index. Apart from that, the current development that has happened on Friday. So Moody's has cut has cut the rating on the US government bonds. So the reason that they have cited is the piling of the debt, which has come at around 35 trillion on the US government, and also the trade frictions that can impact the US economy. Apart from that, if you look at what the Trump government has done, is they have passed the tax cut bills, which could again pile up another $3 trillion to $5 trillion debt on the US government in the coming years. So right now, all these factors are leading the center force in getting the dollar index to come down. Going forward, I think it will be more of a consolidation phase for the dollar index as well. We need some kind of factor or news to get it above 101 or so. But right now, I think there will be a consolidation phase for the dollar index.
Okay. The Indian rupee has experienced fluctuations due to various global and domestic factors, including US economic data, Federal Reserve policy expectations, geopolitical tensions, and India's trade dynamics. Recently, in Fed policy meet, they held on to interest rates. What does this hold in store for India, for INR?
The list. So if you look at the Indian rupee, it is actually appreciated in the past few months. So we are seeing appreciation of almost 2 to 3%. Now the current developments, if you look at, it has benefited from the slide into the dollar index. Then we saw some weakness into the Indian rupee when the whole India-Pakistan war started. So all the appreciation has not been linear one. It has been accompanied by quite a volatile momentum. After the ceasefire, we saw some appreciation, and then again we are seeing some slide into the Indian rupee. So there is a lot of volatility that is happening with the Indian rupee, though it is on the appreciative side. If you look at the whole picture. The numbers, whereas the numbers are concerned, the trade deficit numbers has widened at 6.5% year on year. We are seeing slide into the exports, but the imports have remain robust. So this is creating a pressure on the Indian rupee. So going forward, I think if the dollar index remains under pressure, and as far as Fed rates are concerned, I think considering the economic numbers of US, we could see some rate cut coming into the year from Fed as well. At least 50 bips ka rate cut you can expect for the year. So Indian rupee will remain on the appreciative side. I'm not seeing any steep depreciation. Even if that happens, I think RBI will come in picture and curtail any spike into the depreciation numbers. So consolidation between 86.50 to 84.85 is something I'm witnessing, or expecting, considering the heightened volatility into the Indian rupee.
Okay. So Mr. Trump certainly hopes for the Fed rate cut.
Yes.
He has been very vocal about it. So let's talk commodities now. The global oil market is experiencing a complex interplay of factors influencing prices and demand. While the International Energy Agency (IEA) forecasts global oil supply growth to increase by 1.3 to 1.4 million barrels per day in both 2025 and 2026, primarily from non-OPEC countries. US Energy Information Administration expects the world oil consumption to slow, with increases of less than 1 million barrels per day. Do you think oil will buckle under supply flows?
Well, there is clearly a mismatch with when it comes to demand and supply, in crude oil. Recently, we are seeing some rebound into the prices because there is a de-escalation of US and China trade tariffs, which is pushing that there could be some revival into the demand numbers from China. But if you look at the overall supply picture, like you said, there is, IEA has predicted at least 1.4 to 1.6 million barrel per day ka supply that could increase, and they have downgraded the demand numbers. So, and apart from that, OPEC Plus has come into the picture, where between, I think April to June, they have promised to release almost 960,000 barrels per day into the market. And if you look with the US-Iran deal, if that happens, the nuclear war deal, that will again release around 400,000 barrels per day. So clearly there is a vast mismatch into the supply and demand numbers. Overall, I'm expecting crude oil prices to average at around 65 to 63 dollars per barrel for the for the year. Some spike may happen with the volatility or the development in these trade wars. But overall, I think we are quite well supplied when it comes to the crude oil. So you could see the prices averaging between these ranges.
Okay. And how's the pulse on natural gas?
So NG is quite cyclical in terms. Right now, what we are seeing is, it is it has fallen from the highs because the summers have started. There is the cyclical slowdown into the flows that happens. Then there is some upkeep that happens into the LNG gas facilities. So right now the numbers is on the flow side, it has come down from 106 to 105. So this is leading some support into the NG prices right now. But I think even on the NG side, we are well supplied. US production is expected to grow, whereas the demand, if you see, it is at around 92.1. So there is, on the longer term, at least, not longer term, but at least on the medium term, it looks like that the market will be well supplied, and we could see prices staying around here, or being into the consolidation phase.
So uncertainty buying by investors and hoard buying by central banks has pumped up gold to record levels. Do you see cool-off correlation in the near future?
Gold is already corrected at around 3% from the highs. So I think the whole buying spree has happened during the phase where there was a lot of trade tensions. There was a lot of uncertainties.
Safe haven.
Yes, yeah, safe haven appeal, and then also the conflict with respect to the geopolitical tensions. It was still there. So I think during those phases we had seen gold prices testing $3,500. Right now, if you see, most of those tensions have calmed down. There is a 90-day pause on the tariffs. Then there is a lot of to and fro talks which is happening between Russia and Ukraine, and the India-Pakistan has also calmed down a bit. So I think there is a lot of talks that is going on with respect to the geopolitical uncertainties. So there is some progressiveness that is coming into those aspects. So we are seeing some profit taking that is happening into the gold. If you look at the central bank buying habits, we are seeing some cool off that is happening on that part. So the latest numbers show that there is a 21% decline into the buying year on year. This is probably because the prices have been so high, And even if you look at the jewelry demand, because of the price pressure, there is some decline that is happening in onto that aspect as well. So with that is expected to be under pressure, because the current prices are still very high for the jewelry demand to revive. And if you look at the China also, China has been a continuous buyer for a 6 month, but the quantum has again slowed down to around 2.2 tons. So there is some cool off that is happening from the central bank. What we are currently seeing is the investment demand, which is gaining traction. So we are seeing coin and bars gaining traction. We are seeing ETF flows. So I think the investment demand will provide support for the gold in the coming months. Because the uncertainties have calmed down a bit, you'll see some consolidation which could happen at these levels. So around say 3285 to $3130 ka consolidation is what I'm expecting in the coming months.
What is your outlook on silver?
So silver has been actually an underperformer. We have not seen so much momentum into the silver as compared to the gold, because the industrial demand has still not fared up so well. We are seeing not a linear progress onto the manufacturing numbers, either from China, US, or any major developed countries. So I think this has all in all put pressure onto the silver prices. Whether it will outperform in the coming years, that is still yet to see. Once the economy revives, once the the rates on the central bank part comes down, where the loans becomes cheaper, and it could push the production, or it could put the industrial activity. So I think that's still yet to be seen, and this is the reason why we are seeing back and forth volatility into the silver prices. So even silver prices will remain in a consolidated wide range between $34 to $3150. But yes, I think the light on the silver is yet to shine, unless there is some industrial growth, or continuous manufacturing numbers growth into the economy from China or any developed countries come forth. Yeah.
So you don't agree with the view that silver is going to shine brighter than gold?
Not yet. The numbers don't support that outcome.
New smelters taking shape. How does this bode for copper price trends?
Copper price, or even the whole base metal prices, have indicated some support in the past week. Again, US-China trade deals, it pushes the base metals, because those were the most impacted sector, or the most impacted commodities when these trade wars started. So we saw some revival into the copper prices. Overall, if you look at the copper demand from China, it has remained robust. The concentration, the concentrates and ores, those have been on a growth trajectory when it comes to the imports. Now this could be as a result of the trade war also, because copper was left out. So maybe because from the whole these trade war scenario, US had left out copper. So because so considering that it could come in under the umbrella of the trade tariff war, there was a lot of import that was being done by China. But again, if you look at the PMI numbers, that has again fallen down below 50 for China. Industrial numbers today have come at a slightly better, on a better side, which could support the prices. But yes, for for the prices to again climb towards the highs, we need strong industrial numbers, strong manufacturing numbers from China.
Thank you for the candid discussion, Riya. Great insights. Thank you for being with us. So that's the end of the episode for Commodities and Currencies Monitor. For more enlightening ideas, thoughts and insights, so do like our video, drop a comment, please share it with any of your friends who are looking to start their investing journey. Happy investing.